Betty? Oh, that's Cindy. Cynthia.
All right, so I guess I'll introduce you then. So this is Jonathan with Allianz Mortgage. She's going to be doing our lunch and learn today. So we got about 12 or so people in here. So I'm expecting about 15. That's who registered for it, plus any stragglers. So the program's all yours, Jonathan.
All right, great. Hey, everybody. Good afternoon. Hope everybody's doing fine. Just wave if I'm coming in pretty clear. Am I, Danny? Am I okay?
Yeah, you're all good.
All right, great. Well, today we're going to be talking, of course, about how the COVID has impacted the lending industry temporarily, and also your business. But primarily, we'll talk about 3 points. The first, we'll start with the basic of a mortgage and the programs out there, and just a refresher, and then we'll move into how some of the guidelines have kind of like they've had to modify some of the guidelines because of the current situation and the constricting loan market. And then third, I'll talk to you about give you some insights on the COVID forbearance. All right, so let's start here. I've got my screen. Let's start.
And if anybody has any questions, feel free to type it in the chat. That way Jonathan can see it and answer it. Or click on the raise hand that's on that right-hand side of the participants. That way you guys can interact a little bit with him.
Perfect. Hey, Danny, by the way, I wouldn't know how this works because all I see is the faces of those that are attending and yours. And
yeah, as soon as they type a message to you, you'll see it down there in that lower box. So it'll pop up like an instant message.
Gotcha. All right. Sounds good. So basically what are banks looking for? 5 qualifying factors that lenders consider for a home loan mortgage application. And all of equally importance. Number 1, of course, the credit, employment history, income, property, and funds. Now with the credit, we used to be very, I would say, forgiving prior COVID days, when it comes to credit. But the banks have kind of increased their minimum credit scores for better rates. However, we still do have a few lending sources that will welcome, like for FHA, scores below 500 or 600 down to about 585. Most banks have increased their credit minimum for FHA to 640. Conventional credit minimum scores remain the same. Now, here's a credit score chart of how they rate credit scores, okay? As you can see, 620 to 659 is actually a fair credit rating. 660 to 669 is good. Very good is 700 to 739. And then, of course, 740 to 850 or more is excellent. When you get into the excellent portion, then you get the elite rate pricing, which means you're getting the lowest rate with lowest pricing on that day's prevailing rate. Now,
I lost you when you said that the minimum FICO score for FHA. What is it again?
The minimum, most of the banks have increased it to 640. However, we still are doing 585 on a case-to-case basis, and with some modified guidelines for 585 credit scores. Okay, that applies for both FHA and VA loans. And we'll get to each of those, as we move through the screen here. So basically what you're looking at here is the credit score factors. You could tell that the red, which is the payment history, they consider that as one of the stronger factors. 35%, is plug in there. That affects your credit. 30% of what affects your credit is how much you owe versus the credit limit. So for example, if the credit limit is $1,000 and your balance on that credit card is above 30%, maybe about $400, that starts chipping away into your good credit standing. How you'd like to arrest that is to keep your balances on your credit cards to 30% or less. Is anytime it hits above 30%, it starts chipping out of your good credit standing. Okay, so sometimes folks say, hey, I pay on time. I've been always very good with my credit. You know, why am I not hitting the 700 scores? Well, that's because maybe you're above 30% on most of your credit cards. Now, even if you're zero on, let's say you have 5 credit cards, you're zero balances on 4, but you're maximized on 1 because maybe you wanted to avail of that 0% or 1% rate. You consolidated everything into that one credit card. It maximizes that credit card and it starts affecting your credit score adversely. Okay. Not as huge, but it will start chipping away. 15% of that is a length of credit. So length of credit means how long you've been at least holding your credit card accounts. Anytime you close a credit card, that adversely affects your credit score. So if you don't want to use a certain credit card, it's best to just stare it up and forget about it than to close the account. So be mindful of that. New credit, of course, affects your credit score about 10% of the time. Wherein if you inquire about a car loan or new credit cards and all that, you know, once in every 90 days is fine. But if you inquire 2-3 times within a week, that's going to take a hit on your credit score. And then types of credit used. Of course, revolving credit is the major factor in them determining your score. Less it would be the installment. If you have installment, then usually that's not going to affect your scores as much as your revolving credit. All right. Any questions before I move on? None? Okay. Here we go. This is an example of how your credit scores affect your rate. This is based on a conventional conforming loan limit, which means the loan limit today conforming is I think about 500,000, about 535, somewhere about. So if you have a credit score of 740 and up, FHA is giving you a rate of 3.375, so it's conventional at 0 points. 700, 739, same. Between 640 and 699, see that there's a jump at 3.5 by, you know, about an eighth on FHA and a big jump for conventional. Okay. And then if you're at that 620 to 639, then you start hitting the 4s with FHA and so with conventional at 4.375. 580 to 619, you may be hitting about 4.75 with about a point hit, you know, for that rate. Only FHA is forgiving enough to give you a loan based on these low scores. Conventional, no. Their cutoff is at 620. All right. Debt to income ratio. This determines how a borrower qualifies. Back in the day, it used to be like 33-43 was at least the standard factor, you know, compensating factors if you go a little bit above that. Today, once we run an AUS, or what you call an automated underwriting system approval, or DU is what it's commonly known as long as you don't exceed 46.9 on the front and 49.9 on the back, this is for conventional, then you're pretty much good to go with the approval. Now, let me explain what top and bottom is. The way to compute for the top part of the debt to income ratio is they'll compute for your total housing payment, PITI, principal, interest, taxes, and insurance, divided by your income should not exceed 46.9. The bottom ratio is your future housing payment plus monthly debts, car payments, student loans, you know, credit cards, you know, they add that to your housing, future housing expense divided by your income should not exceed 49.9%. With FHA, they will be able to exceed that up to 55% max or 54.9%, as long as your top ratio does not exceed 46.9. All right. This just shows, like what I said, how your ratios are calculated. Top ratio, PITI divided by income. Bottom ratio, PITI plus monthly debt divided by income. Okay. Employment history, very important to consider. Now, a wage earner, they would like to see at least a 2-year employment history for a wage earner. If that wage earner maybe has been only less than 2 years in this company, maybe just about a year, at least he or she has to show that they've had previous work history, at least for an average of 2 years or more. Now, if that borrower just came out from school and, you know, gone to the workforce, they have to be consistent with their career has to be consistent to what they studied for. So for instance, nursing, doctor, medicine, engineer, business, as long as they show transcripts and diploma of a course completion, then and then their current employment is consistent to what they studied for, then there's a continuation. But they have to be at least 6 months into their new employment for them to have that employment history. As for self-employed people, you have to have at least 2 years of self-employment before your income can be considered. Why? Because they want to see the stability of your self-employment. Now, there are some people sometimes that work in a company, they've been wage earners, and then they switch over to what you call an independent contractor, wherein from W-2s, they now receive a 1099. Guess what? That resets their employment history. Now they're going to have to show, they're going to have to season themselves out 2 years as a 1099 paid independent contractor, because of that switch. So I've had that happen in the past, wherein I told them, listen, you know what? You just switched over to an independent contractor status. If your company is open for you guys to switch to wage earner, then that would be good.
Sorry. I know you worked so hard to get over there, but.
Okay.
I can't hear one
Hey,
thing.
Danny, you still there? Okay.
Mm.
Hold on one second. All right. Here we go. Sources of funds: savings, gift, sale of assets. So that's pretty simple. Savings, they will count your savings as source of funds. However, let's say if you have $20,000 in the bank and then you have a $10,000 deposit, which you can't paper trail. Paper trail meaning, they'd like to see where those funds came from, the origination of funds. If you have paper trail on that, that's great. If it was a cash deposit, even if you had $20,000 in the bank, they will not count that huge deposit as part of your balance. So if you had 20,000, but 10,000 of that is a cash deposit, guess what? They'll only look at the $10,000 that you've had in the bank seasoned out. Gift, anybody can give gifts except for non-blood relatives and cousins. All right. You could be a fiance, an in-law, half brother, half sister, all of that. They can give a gift. And both FHA and conventional are allowing for 100% gift for the down payment and closing costs. Now, if the source of funds is coming from a sale of asset, you have to document that sale with an affidavit of sale. Like if you're selling a car, maybe a copy of the pink slip, an affidavit of sale and all that, and of course, proof of payment. So it's always best to receive either a cashier's check or a check or some sort of, funds other than cash for the sale of that asset. Now, sometimes we could document the cash if the affidavit of sale is $4,500 and that 4,500 cash is deposited within the same date as that affidavit of sale, and a letter from the person that bought your vehicle or motorcycle or boat or whatever it is, that may work. All right. Any questions about source of funds so far? Okay, moving on. Property valuation is also important. Now, this is part of the qualification process. Of course, the pre-approval, the property would have to value according to the terms, a sales price of what's stipulated on the purchase residential agreement. There are times that if the buyer is putting about 20 to 25% down and we run the DU, it would state there that there's going to be an inspection waiver. What that means is, guess what? We don't have to order the appraisal report. Instead, it's just going to be a desk review. So from an average price, a cost of $575 for a property appraisal, just a desk review would only cost our borrower about $180 for the desk review. Once that passes, the file moves on, so the seller won't have to be bothered about inspection being done. Of course, they're going to consider the condition of the property. FHA and conventional are always mindful of the fact that the property has to be in safe and sound condition. Conventional loans didn't used to care as much, but now they're actually conditioning for properties to be repaired to the safeness of the home. For instance, dry rots, evidence of what do you call that, termite, that I just had the property done conventional, and there is a patio and a deep, it looked like a deep ravine right by the patio, and there was no barrier there. The appraiser conditioned for that property to have at least a fence or a barrier so that it keeps everybody safe from maybe falling off that deep end. And that's not an FHA loan, that was a conventional loan. Swimming pools, if the water's murky and all that, you'd be required to at least bring the pool up to condition. If there's no water, that's again a safety hazard. You got to put in water in there. Now, unlike FHA, conventional is not gonna maybe condition for flaking paints, but FHA more than often, almost 100% certain that if they see flaking paint and the house is pre-1978 in construction, they're gonna require you to scrape off the flaking paint and repaint that with water-based paint. Okay, because possibly in that house, if in an older homes, they have lead-based, paint products in there. Of course, the water heater has to be double strapped. Make sure that before the appraisal is done or the appraiser goes in to inspect the property, everything is working. You've got your smoke detectors up, the usual places, and the carbon monoxide in place as well. All right. Any questions so far? None? Okay, moving on. Now, 3 basic types of loans. The most popular are the government and the conventional loans. Government being FHA and VA loans, conventional being Fannie Mae and Freddie Mac. And up until the COVID hit us, we had really great non-QM products, which are private loans and jumbo loans, which were doing very well, especially for the self-employed. Unfortunately, these loans now, when before we used to, allow 10% for self-employed folks to be able to qualify. Now, most self-employed people don't show very much in terms of their tax returns. Of course, everybody wants to save on taxes, and that's why, they have a lot of expenses that they do report and deductions and all that, which cuts down on their net income, which does not allow them to qualify for your normal full doc program. Well, we had the 12 months to 24 months bank statement program, wherein for the self-employed people, all they have to show is that cash flow that they've been receiving versus, maybe the expenses, but what's more important to us was the cash flow, and they would have been able to get that loan for a mere 10% down. Today, that 10% down has been increased to at least 40%, 35 to 40%. There's some banks that are willing to go 30%, but rates are going to be high. So up until things normalize again, I believe the non-QM products will be coming back slowly but surely, but not maybe in the immediate future, like the next 2-3 months. I still have a lot of investors that are waiting for that program to come back. The rates were very good at that time for a 5-year fix. You were actually hitting the high 4s or low 5s. That would have been really great. Okay, so let's talk about FHA. FHA minimum down payment is 3.5%. Maximum debt to income is about 55%, as long as your front end ratio does not exceed 46%. Single homes to 4 unit properties, you could put as low as 3.5% down. However, for the 3 to 4 units, it's a little bit more complicated when applying for an FHA loan because they are required, the property is required to pass what you call a safety sufficiency test, which means, they're gonna have to compute for a 25% vacancy factor based on market rent. And that amount will have to be equal or less than your PITI of that property. If it doesn't meet that criteria, then the 3 to 4 unit properties will not be able to meet FHA guidelines and will not be FHA approvable.
Hey, John, that looks like Cindy has a question. What would the lender use if they both had 1099s and W-2s from different employers?
If they have 1099s from their employers, then we would need to see the last 2 years tax returns because we'd have to average out your net income. Now, remember,
can I elaborate a little bit on this one?
Go ahead.
My client actually, he has a 1099, but he's like a subcontractor for a company. He's not on payroll, but they pay him with company check. but he also gets a W-2 from another company doing the same job. So I don't know. You know what I mean?
It's a good question. Yes. Because he gets 1099, then we're going to have to get both his W-2s, 1099 forms, and 2 years tax returns. Okay. And his W-2 definitely will be plugged in as the income, and so will his 1099 income be. Usually you find that on the Schedule C of the tax returns. Now, if he declares a loss, let's say on his 1099 income, which a lot of them do rather than gaining, reporting a gain, that loss is going to eat up into his gross income of the W-2 income. So let's say, for instance, he's making like $40,000 a year on the W-2, and then he makes $40,000 a year in the 1099 income, but then he reports like $50,000 expenses, losses, whatever, and then expenses rather, and then that gives him a negative $10,000 on his 1099. So now it's going to be 40,000 W-2 income less a $10,000 loss. It's going to be like a $30,000 income. That's how it's going to affect him.
So in this case, he probably not qualify because he actually, his 1099, he practically disappears all the income. He declares losses. So his net, I was checking on his income taxes, is like 14,000.
How much is it?
14,000 out of
14,000.
like 60. He went all the way down to 14,000, and his wife doesn't make much money, so
Okay.
I'm screwed.
Well, not really. Check it out. We just have something that came in, which how much down payment is he putting, by the way?
He's selling his current property and he's thinking of putting like a 20% down.
Perfect. Because the reason I tell you this is because he's got the wage earner and he's working with a company that's actually paying him 1099. We have a program wherein we only do VOE only, okay? Verification of employment only. So that employer could go ahead and plug in the gross income that he's earning on a 1099, and that could be used. And since he's putting about 10 to 20% down, I think he's definitely in for this program. How's his credit score like?
I don't know. I have not checked him. I actually just saw the income taxes and I was like, okay, I have no idea if you're going to qualify or not. We barely got into escrow selling their property, so we kind of like waiting a little bit just to see how this escrow is gonna pan out.
All right.
Well, you know what I mean?
Yeah. You know what? Let's take the guesswork out of the way and let's get him qualified. And I'll send you a link to my online app, Cynthia. But definitely, we do have this loan, VOE only. The good thing about it is that he's not totally self-employed because he actually works for a company that 1099s him. So actually, we could get a VOE, a verification of employment, with that company and the other company as well. And the only thing is the rate on this one here is going to be in the mid to high fours, which possibly a cost of about 1 or 1.5%. But at least that gets him into a home for now. And then eventually, hopefully, if he wants to switch back to W-2 income just to refinance out of that higher rate, then you could do that. But for right now, definitely we do have a program that could address the situation. All right.
Okay, could you just send me after the meeting the link or put the link on the meeting on the chat for the application? That would be great.
All right.
Thank you, Jonathan.
Hey, you're welcome. So as I was saying, with today's COVID situation, most banks increased the credit score from 580 to 640, but we still do have a lending source that does a 580 credit score for borrowers. However, the downtime on the underwriting turnaround time for this is going to be long. Okay, so if before we used to do this type of loans within 30 to 45 days, you're looking at about between 45 days to 60 days to get this thing done, but it is possible. All right. And also, generally speaking, what happened to the turnaround times for most loans is that when we used to close loans within 20 to 30 days, because of the new protocols that the banks are having to experience, with a lot of half or more of their staff working from home and all that, the downtime has been increased to, another 10 maybe or 15 days longer. And so when you're getting into escrow, I would suggest that I'm sure everybody would understand that, an escrow time right now, at least a reasonable time, if you want to be closing on time, would be about 45 days, depending on the simplicity or complexity of the loan. All right. We may still be able to close maybe past 30 days, before 45 days, but for the most part, 45 days would be pretty safe for all of you to get into an escrow timeline. Now, single and 4 units, I think I already discussed it. 3 to 4 units. You know what's required from the property. No credit's still good, as long as the borrower has a cosigner with a good credit score. That cosigner will come in with the borrower. And what's required from the borrower with no credit score is he's got to provide at least 4 or 5 trade letters saying that he's been on time for the last 12 months, has been with that account for over a year. For instance, utility bills, fire insurance, not fire insurance, but rather insurance for the car, cell phone, and of course the verification of rent. If he's renting, then we're going to send out a verification of rent to the landlord. Still with FHA, no reserves required unless his credit scores are below 620. And it's a case-to-case basis. It might be 2 months reserves required, 3 months reserves required. 100% gift, still okay. Forget the 5, and then you see the 550 FICO scores here, okay? Used to be okay till COVID hit us. So not anymore. If we're still at 2-year seasoning on bankruptcy, foreclosures, we're still at 3-year seasoning, unless they could provide extenuating circumstances, like maybe they got hit in an accident that caused them to not be able to, that caused them financial hardship. They had to go through this. That's a different story. We'll look at it on a case-to-case basis. Seller can pay for all the closing costs in this case. Okay. Now, 203K streamline. This is also an FHA loan, but it's more for properties that need rehab work. There are 2 types of 203K. The 203K streamline, wherein they limit the rehab costs up to $35,000. Usually, this is for updating beaten up kitchen or not functioning bathrooms and all that. Maybe some cracks in the walls. Maybe you need to change the flooring. You could go with a 203K streamline if you don't have the budget to fix up the house. And of course, for FHA, they would require the house to be in good condition prior to occupancy. 203K streamline does not require that. They will lend you the funds. It's going to be in escrow for your general contractor to draw from. And usually it's 1 to 2 draws because it's just a small amount, $35,000. Once they complete the work, they'll submit their invoice. Escrow is going to pay them. It has to be completed within 6 months of occupying the property. And basically that's about it. Whatever is stipulated on the contract of what has to be done that's going to be on your loan documents and the borrower's loan documents. The borrower would have to adhere to that strictly. The borrower can't deviate from any of the repairs other than what was totally required on the contract. I had this one borrower one time, he got the streamline, and then all of a sudden he decided to gut everything in his house. And from a $35,000, it was a $100,000, repair, which he had the money for anyway, but he was not able to complete the work in 6 months. So when the inspector came in, the 203K inspector came in and saw the house was still partly gutted, they had to call the loan. I had to step in, negotiate with the bank and say, listen, don't call the loan back. It's going to be costing this guy hardship. Allow him to finish up with his, construction. It might take another 2-3 months. It was really a challenging situation. So, they're very strict about what kind of repairs you're doing. So whatever is stipulated on the repairs that you're going to be doing on this property has to be solely and not in excess of that. Now, if it's a little bit in excess of that, as long as you're done with the repairs within 6 months, you're good. But don't totally gut the house. This guy just told me he made it a tear down instead of a rehab. Okay, so that's with the streamline. Now there's another 203K streamline, which is what you call the regular rehab loan. The thing is, it's the more distressed properties. So you have to do more than $35,000 worth of work. This one gets a little bit more complicated, but it's possible. We're going to have a HUD inspector go in there, do a feasibility study on top of the appraisal inspection. And then, of course, you may have to have the city come in and inspect every step of the way in fulfilling, the type of work that has to be done on the property. It's doable. We could lend as much as maybe $100,000, to do the repairs on the property. Now, remember, 203Ks, these are for residential occupants rather. They're not for investors, but it does give at least folks the ability to purchase a fixer-upper home, maybe for a lower price versus a house that's already in built-up condition. And they could do the work there, but they have to hire a general contractor to do the work. Of course, the estimates, labor, and materials will have to be submitted. We have all the different forms. There are several steps to this. in addition to your regular FHA loans. So usually, you know, when it used to take only 45 days to do this, it may take 60 days. I remember doing one for Danny, and
Yeah, I wanted to add to that. Like, it was a pretty seamless process, and our home really wasn't a fixer. It didn't have a heater. So in order to qualify for FHA, it had to meet those guidelines. So we
right.
got to fix, the water heater. We had to fix a lot of other things with that additional fund. So it's a nice way to have your buyer finance into that and get it still under FHA with a low down payment.
There you go. Right. And right after doing the work, I bet your property kind of, you know, went up in value as well. So you're
And we were able to refinance this year. So it's amazing what FHA can do.
That's cool. Cool. Okay. Any more questions about 2 or 3K rehab loans? Okay, let's move on. VA loans. VA loans still pretty much with the same guidelines that we have. Minimum credit score is 580. You know, after BK seasoning of about 2 years. If they're into a bankruptcy 13, at least 1 year with on-time payments, and they'll have to get a court permission to purchase a house. You know, the court gives us that permission. They could provide us that document, then we're good with that. There's no PMI. It's a zero down program. For those that have permanent disability, they don't have to pay the upfront VA fee of about 2.25%. And again, it's 2.25% upfront. So what that means is if the borrower is purchasing a $100,000 home, his loan is $100,000. Usually they tag on the 2.25% VA funding fee. So now his total loan amount is $102,250 for first time. If it's a second time use, it's at 3.5%. So it's going to be $103,500. But if he has permanent disability because of him being in service, then that upfront fee is waived. Okay, so we can pay for 100% of the closing costs. Excuse me. No reserves required. No credit okay as long as spouse has scores. The only co-signer for a VA loan is a spouse. Although they're saying that you may have other co-applicants, another VA borrower on the loan. That's great, but that VA co-borrower has to have exactly the same benefits as your primary borrower for this whole thing to work. It's less complicated just using a spouse. And again, it's a case-to-case basis with other co-signers. A spouse of deceased vet may qualify for a VA loan because the benefit, flows down to her. Okay. The VA loan could give you a loan amount up to 2.5%. You'll definitely have to put down a down payment, when you're hitting these $1 million mark or homes. But we go through a computation wherein we compute what the down payment is going to be, which is usually less than 10% or maybe 10%, but you'll be getting definitely a better rate with the VA rather than having to go with the jumbo loan. So this is available for VA, for vets who are purchasing in excess of your high balance conventional loan limits. Any questions about VA, folks? We're good? All right. Yes. Okay. Yeah, I hear somebody there. Okay. Conventional loan. Okay, so with conventional properties today, when we're doing a lot of refis, I see a lot of title transfers. Father's been living there, or they had first their kids qualify for the loan, maybe because they got hit prior with their credit. Now that they're in good credit standing, they'd like to take over the loan, and apparently they have not been deeded into the property yet. Well, the good thing about conventional and even part of FHA is that you don't need to be seasoned into the property to do a refinance, as long as you could prove that you've been living there for over 12 months. And sometimes if you're the one actually making the mortgage payments and not the person on the loan, like your child or whatever, just show proof, 12 months proof that you've been making the payments. If you're not making the payments, proof of residency in that subject property, that's fine for refinancing. W-2 forms are okay. Prior to COVID, they'll accept just W-2 forms, but now they will need to see the tax returns again. Okay, so these guidelines are actually like loosening up, tightening up, loosening up. So we were loosened up before, and now we're kind of tightening up again the floodgates here, but still following the same guidelines. So with the tax returns, what they're looking in at the tax returns is that if you are declaring, like what Cynthia said, if you're a 1099 income borrower, definitely you're going to be filing for a Schedule C. That's a self-employment income. Schedule E is for rental income. So if you have rental income there, and the borrower has rental income, we need to see at least 2 years worth of rental income to count that rental income if he has another property. If not, then we can't count that income if he's only rented the property for about a year. But if he shows a 2-year history on that rental, then it's fine. K1, usually if he has an S corporation or whatever, or a partnership going on, they'll have to show the tax returns of that partnership or that S corp or that C corp, and whatever K1 income is filed along with his personal tax returns. Now for conventional, BK from discharge 2 years with extenuating circumstances, which means usually it's a 4-year seasoning from the date of the bankruptcy. I'm sorry, the term skips in my mind, but from the date of discharge, rather. From the date of discharge, it usually is 4 years. However, they will consider if you have extenuating circumstance why you filed for bankruptcy, as long as you're after the 2-year period. Okay, bankruptcy 13, they would like to see a 2-year history from the date of discharge, or 4 years from dismissal, because it's either discharge or dismissal that you get. Foreclosure, strictly 7 years. Okay, so if you had a foreclosure in the past, you can't buy conventional unless you've seasoned out your foreclosure sale and it closed 7 years ago. Deed in lieu foreclosure and short sale, they would require a 4-year seasoning before you could purchase again. However, if it was a short sale and you're, for one reason or another, you weren't late on your mortgage payment, that happened to a few borrowers back in the past, then they will allow for that. I don't see much of this going on now for the last, I would say the last 3 years. Hardly do I see this bankruptcy or BK foreclosure or short sale being an issue. It used to be an issue back in 2012, 13, and 14. As 15, 16, 17, as we went further away from the past, I'm not seeing much of that anymore. So that is it. Now, non-QM products, hard money loan and all that, it's not available on a commercial scale right now. However, if you do have investors that would like to invest, I do have a private source that would be willing to lend as long as you could put as much as 30 or 35% into the property. Of course, they will lend you based on the basis of the equity going in. So you're putting skin in the game of 35%. This investor will probably lend you some funds, not too expensive. Usually hard money is going at 10, 11%. This guy is lending at about 8.99 to 10.99, depending on the project. So if you got something going on with investors, feel free to touch base with me and let's see if we could get him some funds for that fix and flip or investment property. Now, COVID, forbearance. You may have some clients right now that you've closed and they might be experiencing some hardship because, maybe they were affected, work was affected by the situation. The banks are open to do a forbearance on them, and they're open. It's a case-to-case basis depending on their needs and the plans of the bank. So I would recommend that they do call their banks if they're in that situation, and the banks will be able to say, okay, we'll stop payment for the next 6 months. However, what you owe us for the next 6 months, we're going to have to add on to your principal balance. Or you're going to have to pay, upfront once the hardship is over. This is something, it's a case-to-case basis, but it's something you could bring up with your clients, touch base with them, let them know that you care, and let them know that this is available in case they don't know it's available. When this happened, I actually had a couple of clients that did give me a call, and they were very frantic and they didn't know what to do. The wife lost her job. She was furloughed, I believe that's the term you call. And so I told them, called their bank and explained what had happened. So a couple of them were able to actually get a forbearance, a break for no payment of 6 months on their mortgage. And however, I was told that they were going to add that, that money owed it's still money owed. They're going to just add that onto their principal balance. All right. So that's where we're at. Now, if you need more information about the forbearance regarding COVID, here's a link. I can share this with you. And for those of you that would like to get a copy of this, at least this is a seminar, just go ahead and email me. My email address is lenderguide@gmail.com. It's lenderguide, GUIDE, @gmail.com. And I will email this to you, and you could get, this link and maybe share it with your clients. All right. Also, for those of you that have borrowers that, are on the fence, they don't know what to do, and you may not have enough materials on things to consider when buying a home program, I have this great material that I could share with you that you could forward over to your clients. And it's about, mostly first-time home buyers. They definitely benefit from getting this booklet and having to read over this and have you be the source of their go-to person for purchasing a home. So basically that concludes my presentation. Do you guys have any questions?
Does anybody want to ask Jonathan a question? I can unmute everybody if you can't figure out how to mute it yourself, or go ahead and just type it in the chat down below. We can give you guys about 20 minutes here to have any questions you have for Jonathan. So let us know.
Now,
click the raise hand. I can unmute you or turn your video on and wave in the screen, something that I can see. So go ahead, Jonathan.
All right. You know what? I'd like to share with you a strategy when you're doing maybe a purchase offer or talking to a client who may have limited funds. Let's say he only has enough funds, or he or she may only have enough funds for a down payment, and you may need closing costs. Or even if they do have the the amount of funds for the closing costs and down payment, and they want to retain some of those funds for emergency. Let me show you. Hold on one second. Something in here. Okay, here's the screen. So what I could do is I could come up with a buyer's analysis of which way is the best way to go. If they'd like to go borrow paid costs, which means they put this one is just an example. It's a $550,000 purchase price. It's a 10% down. So that's the loan amount, 10% down. It's a conventional loan. They're coming in, today's best prevailing, by the way, for 10% down at $495 is 3.25%. How about that? It's really good. Down about an eighth from yesterday, which was at 3.375. Now, keep in mind, rates are a moving target. There's no guarantee until we get into escrow and lock the loan in. But for right now, this seems to be the going trend. It goes up, goes a bit down, but lately it's been kind of on a downward trajectory. So if the borrower was coming up with his own down payment and closing costs, he would have to come up with about $65,474. All right. Usually when you put less than 20% down, most of the borrowers nowadays would like to include their taxes and insurance into mortgage payment. That would be PITI, okay, for this purchase. Now, when you go with an impound payment, what happens is they collect at least 6 months worth of your property tax, 1 year plus 6 months, or 1 year plus 4 months worth of your hazard insurance. And so what happens is they'll have to bring that money in along with the down payment and the other closing costs, which is escrow, title, and lender fees. And so in this case, their down payments are like $55,000. Another $10,000 tag in there. Of course, more than half of that are the reserves. Again, the reserves, it's their money that's put in an escrow account. It's not an expense, but it's an upfront reserve that you're giving because the bank is paying your taxes and insurance for you, and you're providing the reserves into an escrow account for the life of that loan. Now, if that loan is, if that borrower sells the property in the future, refinances out of that, or pays it off, whatever's left in the reserves is refunded back to the borrower. In this case, on a normal borrower paid transaction, the borrower would have to come up with about $65,474. Now the borrower says, listen, I have all of that. I have like 70 grand. However, I'd like to still have at least some reserves, getting into the property. I don't want to go more than, what the down payment is. You could negotiate for the seller to pay for closing costs. But if the seller is pretty maxed out at 550, then what if you tag on the extra $10,000 of closing costs into the sales price? In effect, you're financing the purchase, the cost of doing the loan into the purchase price. So now the purchase price is 560,000. Seller pays 10,000 towards closing costs. And here is where the borrower comes in with only 56,750. Now notice the difference between seller paid and seller credit rather and borrower costs. Not very much really. It's about 54 bucks, but the borrower saves about $10,000 of his much needed cash that he might want to keep for in case of emergency.
Yeah, I was gonna say this is a good scenario for what's going to be coming up here in the next 3 months. Is there's going to be lack of inventory, so there's no buyers out there that are going to get deals. So the best is if you have a property like this case that they're qualified for up to 560 or 570, and the purchase price is 500. Offer 510, offer 500, offer the full price, and then go back and ask them, like, hey, can I offer 10,000 more? And you'll just credit that back. The seller will usually agree because they're getting the same amount of money net at the end of it. But it makes it a lot easier for the loan, and you don't have to compete with all these multiple offers. Because right now, I mean, every property that's on the market is selling in still 20 days right now. So keep that in mind when you're working with these buyers, and it's only going to get worse. So everybody that's used to what we experienced in April to March to April with this height of the real estate market, this is all going to go on until November because of this delay. So you guys are going to have a great Christmas as long as you're working with buyers right now.
Right, exactly. And they expect, once this whole thing is over, there's going to be a pent up demand for actually real estate. So I see a bright future, coming into the next year, but we just have to weather these challenges for this year. And hopefully we'll see the light at the end of the tunnel after the third quarter or within the third quarter. But yeah, so the third option is lender credit. Let's say, for instance, the bank can go as high as 560 because it's pretty max on the value. The borrower has limited funds, only enough for 10% and just a few reserves. Well, what can happen is maybe the lender can go ahead and credit. I'm sorry, it's not reflecting here. It should have reflected. The lender in this case is crediting about $9,000 towards closing costs of borrower. However, you see that the lender has to increase the rate in order to get that rebate to pay for the borrower's closing costs. So this should be 65 less 9,000. So that should be somewhere in the vicinity of about 54,000, somewhere abouts. Hold on one second. Yeah, somewhere abouts. So again, you could minimize this one here. So it should be about 56,000 rather. So with the lender credit of, based on the 3.875 rate, this amount here should be at 56,000, okay? So borrower can come up with at least 10% down, just with a little, extra, for the overage of the reserves and all that. And the borrower takes care of the rest of the closing costs. So this is worst case scenario. Usually people that get into this is wherein there's no more room for the increase of, price because of the value of the property. And the borrower is actually qualified, for about this rate, and they just want to save in cash. So we could go with the lender credit. So these are the different, offer or sales scenario that you could, or purchase scenarios that you could discuss with the borrower. And usually, you'd like to chime me in there and get me in the discussion. I'd be more than happy to do so. I do have my program analysis that I could always present to them and also answer all their questions and keep them at least comfortable and informed, moving forward with, this big purchase of theirs. All right. So that in a nutshell, folks, is my lunch and learn. It's nice seeing you guys after such a long time. Hopefully we get to see each other again personally. But for right now, we'll just be zooming in, I guess. And this is my first Zoom in, so I'm having fun.
Yeah, and the office is still open from 9 to noon. So there is still the large conference room if we wanted to actually meet with clients to kind of keep that social distancing. So Jonathan could always come in, show them everything on a screen, and they can always sit at the end of the table in the conference room. So we could still get that face-to-face if they actually need that, hand holding for that certain kind of, first-time buyer or somebody that needs unique situation there. So keep
Yeah,
that in mind as well.
That's great. And just to let you know, I have met with a couple of borrowers in my my office over in Whittier, and the way we set it up is we had at least a table with a 6 feet distancing. They came in with their mask. I was in there with my mask, and we had all these towels and all that. So you know, during this time, and we need a face-to-face meeting, I have my safety kit with me. So you get that, you know, all those sanitizers and everything, with a safety mask, of course. All right.
All right. So anybody else have any questions? This is your last call here. Don't see anybody else, so we'll wrap up the meeting. So thanks a lot, Jonathan, for hosting this. And then next Thursday, we'll have Ray K with Searchlight Financial. So he'll be able to give us kind of a forecast on it, which will be interesting, seeing as this is probably the first wild card that a lot of us have seen. So I'm interested to see what he thinks about the stock market, you know, about lending in general too, since that's kind of where his specialty is. So thanks for joining us, guys, and thanks, Jonathan.
All right. See you guys later. Stay safe. Bye.
Thank you, Jonathan.
You're welcome. Oh, by the way, you guys send
Thank you,
me
Danny.
email me, okay? If you want more information about this.
I'll give you a call.
You got it. Okay, thanks.
Okay,
Bye-bye.
bye.